Class we had studied what is the commercial bank, what is the origin of commercial bank, what was the need for banks in our Indian economy, and the role of commercial bank. And we could observe that how banks have contributed significantly towards the development of our economy from being underdeveloped country into moving into a developing nation, and one of the fastest growing. Banks or the banking institutions have played a significant role. We have seen how banks channelize the savings of people into investment, right? They are the platform, or banks are the platform or an one stop for public or individuals to put their savings into, and also for traders or businessmen or for entrepreneurs to pool their investment or capital from the banks. So it is a one stop for both, for people who have to save their money and for those who have to borrow money or raise capital for the business purpose. Correct? So we had discussed about the meaning, origin of the banks, need of the banks, and the role of commercial banks in India. So today we'll be only discussing about the classification of commercial banks. So as you see on your screen, we have three different bases or classification. One is based on the statutory provision. One is on the basis of statutory provision. Second is based on the ownership, and third is the basis on domicile. Domicile means just the place of origin. Where is the bank headquartered or origined, etc. On the basis of statutory provision, we have two types under that: scheduled banks and non-scheduled banks. Under ownership, we have two types, that is public sector banks and private sector banks. And on the last one, on the basis of domicile, we have Indian banks and foreign banks. Let's discuss each of them. So first we'll be starting with the on the basis of statutory provision classification, point A. Under that, the first type is scheduled bank. What are scheduled banks? These are banks which are listed in the second schedule of the RBI Act of 1934. So all the commercial banks, right, all the banks in India are being controlled or regulated by the regulatory body called as Reserve Bank of India. Correct? This is the Central Bank of India, which is being regulated or lay down instructions or the guidelines for the banks to function effectively. So all those banks which have been registered and listed under the RBI Act of 1934 under the second schedule, all these banks are pertained to be called as what? Scheduled banks. Now, in order a bank to be a scheduled bank, what are the conditions or norms it has to fulfill? Let's look at that. The banks must have a minimum paid up capital and reserves of rupees 5 lakh. So, if a bank has to be a scheduled bank, its basic minimum paid up capital. It does not say maximum. Note that point. It's just minimum. So, in order to just start a bank, you at least need a capital of rupees 5 lakh at your disposal. Okay, that is capital plus reserves 5 lakh. That's your minimum. Maximum, there is no limit. You can go up to whatever your financial capability is as a bank or a financial institution. Next, the banks must be incorporated and carrying on business of banking only in India. Now, if a bank has been incorporated, means registered or located or headquartered. Is that clear? So, these scheduled banks must have been originated in India. Okay, and where are they going to carry on their business? In India. Is that clear? So, such banks are called as what? Scheduled banks. They should have a minimum paid up capital of 5 lakh. They should have been originated or incorporated and working in India. The banks must satisfy the RBI that the affairs are not being conducted in a manner detrimental to the interest of depositors. Now, what does the word meaning detrimental means? To cause harm or intend to do some fraudulent activities, basically to cause harm to the public or to the depositors. The public or individuals are opening bank accounts and depositing their hard-earned savings in our bank account. It's not for the intention that we may misuse those funds or cause any kind of damage to their deposits, correct? They're depositing in the bank, reason being it is a secure platform or it is a safe platform. That's why all the banks are being governed by the Central Bank of India, so that if banks were being carried out, or this investment or this deposit, the entire concept, if it was in few hands of individuals or institutions, it would mislead or cause harm. That's why the entire institution of banking came, correct? So the RBI, all the commercial banks, whoever wants to be a scheduled bank, they have to prove themselves or make sure their intention or the purpose or objective of setting of bank is not to cause any kind of harm in the interest of depositors. So they have to make sure we are existing or we are established as a commercial bank or as a scheduled bank to serve the customers, okay, to contribute towards the growth of the economy, to help the rural people, or to lesser the interest rate, and make sure we do not have any kind of fraudulent activities within our banking business activities. So all these things, commercial banks or scheduled banks have to prove it or have to inform it to the Reserve Bank of India. That's their third condition. So presently the RBI has prescribed a minimum capital of 100 crores for stating a new commercial bank. So back then 5 lakh was the older version, or when initially banks were set up or RBI was set up. So as and when India is developed, the economy is developed, and everything is changing for our better, or for the better economy in terms of capital, standard of living, employability, salaries get hiked, etc. And also the paid up capital also will be increasing. The second type under the statutory provision is called as non-scheduled banks, just the opposite of the first one. What is a non-scheduled bank? These are the banks which are not listed. Notice that word, are not listed or not included in the list of the scheduled banks are called as non-scheduled banks. Banks with a reserve capital of less than 5 lakh rupees qualify as non-scheduled banks. So if any bank which has a paid up capital which is lesser than rupees 5 lakh is called to be as what? Non-scheduled bank. At present, there are only 3 such banks in our country. That's a past data. But then over a period of time, we have many local banks. I'll be showing an example just up the slide. How many local banks, or according to the RBI status, according to the RBI's research, or according to their calculation, how many non-scheduled banks do we have in India? What are the other conditions for non-scheduled banks? Non-scheduled banks have to follow the CRR condition. So next class I'll be discussing with you the various bank ratios that every bank has to follow. It's commonly called as SLR ratios and CRR ratios. Okay. Now CRR stands for cash reserve ratio. I want you to remember the full forms of these ratios, because these are the ratios very important for the effective functioning of any single bank. So these non-scheduled banks are not eligible for having loans from the RBI for their day-to-day activities. But under the emergency conditions, RBI can grant loan to them. Now here, when we looked at the scheduled banks, we could see that anytime the commercial banks or the scheduled banks are running short of funds, whom do they approach? Reserve Bank of India. But that does not happen in the case of non-scheduled banks, because they are non-scheduled and they do not have direct access, or for running day-to-day business, if the funds are insufficient to run the day-to-day business, if funds are insufficient, they cannot approach the RBI. But only on the terms of emergency conditions will the non-scheduled banks have the access to take a loan from the RBI. Is that clear to you? Next, scheduled and the non-scheduled banks both need to maintain the cash reserve ratio But scheduled banks have to deposit this amount with the RBI, while the non-scheduled banks can deposit this amount with themselves. Now here what is cash reserve ratio is the total amount of deposits that the bank has collected from the public or from individuals. Among the total deposit, a percentage that is fixed by the RBI, scheduled banks has to keep. Let's say they've collected 1 lakh rupees, okay? Now 10% of that, let's say it's 10,000 rupees. CRR 10 percentage means scheduled banks have to keep that 10,000 rupees with whom? With the RBI. They have to deposit with the RBI, because if the entire money is in the control of commercial bank, they tend to give out all the money in the form of loan or create credit, and tomorrow they will be running short of funds. For the same reason, banks are asked to keep a percentage of their total deposit, called as what? Cash reserve ratio with the RBI, deposit with RBI. So that way you have a backup. Even though you're running short of funds, your own deposit money is lying with the RBI. So you can take back your own money in the time of emergency. But for the non-scheduled banks, it is not so. Non-scheduled banks can deposit this amount with themselves. So it is at the risk of their own disposal, because anyways we know that the minimum capital is less than 5 lakh. So so basically the CRR percentage will also be less, correct? Because their capital is low than the scheduled banks, their even cash reserve ratio will be lesser than the scheduled bank. So they don't have the obligation to keep it with the RBI, but they can keep it with themselves. So these are the conditions of non-scheduled banks. So this is the list from the RBI's website, Reserve Bank of India website, where it has listed few of the non-scheduled state cooperative banks. Okay, so these are the banks, that list that you can see, right? So these are called as what? Non-scheduled state cooperative banks. So these banks are not listed in the second schedule of the RBI Act of 1934. Moving on to the second classification on the basis of ownership. The first one is public sector banks. What are public sector banks, or PSBs? Are a major type of banks in India where a majority stake, that is more than 50%, is held by the government. Now here what happens in public sector banks, as we have discussed earlier under the financial institutions of the first chapter, public banks, let's say their number of shares is, they have 100 shares, okay, 100 equity shares in the bank. Now public banks are those where more than 50% of that shares are held by whom? Government of India. Okay, so in majority in India, we have majority running is public sector banks, because these are controlled and governed by the government. So we always have more security or trustworthiness towards what is owned by the government, because we feel our deposits are safe and secure. For the same reason, public sector banks have more than 50% of share or held by the government of India. Anything, even if it's 51%, will that account to majority? Yes. Out of 100 shares, 51 shares are held by the government of India. That means it is the majority. The rest 49 can be held by private institutions or individuals or anybody else. But then majority of the shares are held by whom? Government of India. Such banks are called as what? Public sector banks. Opposite, what is a private sector bank? Private sector banks are banking companies with majority stake or equity being held by private shareholders and not the government of India. So it's just the other way around. So in private sector banks, does government have a share in it, or do they have a holding of shares in it? Yes, definitely yes, but not in a majority. In the minority, government of India will have a stake, maybe just say 30%. Out of 100 shares, only 30% is held by government of India. So the rest 70%, who is it controlled by? Private shareholders. Is that clear? So private sector banks are where the majority of the shares are held by private individuals or shareholders, and the minority or 30 or less than 30 also possible are held by the government of India. Is that clear? Hope you have understood the second classification, public sector banks and private sector banks. Moving to the last one, on the basis of domicile. Domicile, as I told, place of origin. Where is the bank originated or started or incorporated or registered? Is that clear? Under this, we have two categories. First one is called as Indian banks. As the name itself says, Indian banks, the bank is where is it incorporated in? Indian boundaries. Is that clear? Anywhere within the Indian boundary, if a bank is established, registering under the RBI Act of 1934, it is called as Indian Bank. Okay, and the conduct of the business and where the business is carried on, it is within India. And the last one, foreign banks. A foreign bank branch is a type of a foreign bank that is obligated to follow the regulations of both the home country and the host country, because the foreign bank branch has loan limits based on the total bank capital. They can provide more loans than the subsidiary banks. Now here, foreign banks. Now Indian banks, where is it headquartered? In India. Foreign banks, where it is headquartered? Wherever it is originated. Maybe it can be Germany, maybe it can be USA, or maybe it can be any other foreign country where these banks have been originated, established. They've been registered under their respective central bank acts. Understand? Like example, Citibank. Okay, this bank is not a Indian bank, it's a foreign national bank. So it is headquartered elsewhere, but it has a branch that is having business financing activities in our country. You understand? So they have to follow the rules and regulations of what? Both home country. Which is home country? Wherever the bank is originated, that becomes the home country. Whereas the host country, where it is right now operating its banking activities. Okay? So India is its host country where it is operating its business activities or banking activities. So it has to follow up certain guidelines laid down by its home country, and because it is situated in India, it has to follow up certain rules and regulations according to the government of India, or wherever it is situated. Let's say it is situated in Bangladesh, it has to abide by the rules of Bangladesh. Is that clear? So this is called as a foreign bank. So today we have studied about the classification of commercial banks. First one is on the basis of statutory provision. We learned about schedule banks. It is those which are listed under the second schedule of RBI Act of 1934. It has certain conditions, that its minimum capital must be above 5 lakhs. It must be incorporated and working in India, and it is not instituted to cause any kind of harm to the depositors. Second, non-schedule banks, where it is not listed and they must have a capital which is less than 5 lakh rupees, and they have to follow the cash reserve ratio conditions. These are the examples of non-schedule banks. Your second category is on the basis of ownership. Public sector banks, majority stake held by government. Private sector banks, majority stake held by private shareholders. The last classification on the basis of domicile or place of origin. One is Indian banks and the second one is foreign banks.